let's come down here for a minute. And just look at our weighted average cost of capital worksheet. So here, basically we're just going to walk quickly through, the calculation that we have on our slides. It just has all the elements here. We have the public share price, which at the time was $27,093. We multiply that by the diluted shares outstanding to get a market capitalization. Same market capitalization we would see if we looked on Yahoo Finance or, CNBC or wherever, right? So that gives us, sort of an equity value, if you will. We actually, add in the debt, subtract off the cash. So the net debt is just the total debt minus the amount of cash in the books, and that'll give us sort of an enterprise value. So enterprise value refers to the amount, the actual deal cost, right? Because in the real world, if a company has, $5 million in equity, but they have $25 million worth of debt on the books, then you're gonna have to come to the table with $30 million in order to get the company. In theory, in practice, the debt holder will probably just pass the debt on to you. But, in theory, you have to pay the debt too. And the cash, though, you get to take out of the business immediately. So that's why you subtract the cash off.
CVS doesn't have any minority interests or preferred equity.
They have preferred equity. In this case, how do we deal with that? Yeah, in this case, and diluted 260. Yeah, it's
As you should have.
well. This is the thing, is that the common shares are what are out there tradable for you to get control or not. So I would actually have to go back through the model and see how we accounted for them. But the debt is out there objectively, and the common shares are out there objectively. In terms of what happened with the preferred shareholders, I have to see. The preferred shareholders don't vote, and like I said, they're also not publicly traded, so it wouldn't be a part of the purchase price.
They're part of it.
As such.
Can I ask a question
Sure.
about that too? Because I think what we're trying to do is figure out WACC, right? And so
Yeah.
we're trying to figure, enterprise value represents the true value of the company regardless of who owns it, debt or equity.
Right.
So you take out the cash because it should already be priced as far as the stock price,
Right.
the cash value.
Yeah,
Then
exactly.
you figure out what the value or the claims of the bond holders or the debt holders and
Yeah. Which are objective.
be like a claim on that value if we're trying to figure out WACC, not how much we're going to buy it for. I don't know. I mean,
But the weighted average cost, the equity value is derived from specifically from market capitalization,
right,
which is just common.
right. But
So, I mean, you see what I'm saying?
And that's a problem.
And the debt value is based on what has to be,
right.
what has to actually be paid
Yeah,
off
but
in the
you
transaction.
bring up a problem with
Yeah.
WACC, which is that they don't include preferred equity.
Well, they do. I think it's all debt. You know, you're looking at market, you're looking at the capital structure of a company, and it should be equity and debt, and usually it's considered.
Alright.
No.
And that's, I don't know, I mean,
I think
that's
that's
my
the
experience,
different
but I really
components, I
think.
thought.
It is
That's
considered.
debt, that's
Yeah.
preferred equity and that's common equity, right? The three components. Different?
The common equity is going to be the only thing that figures into what you have to come out of your pocket to pay for in the transaction. You know, so that's why in the model, you know, they really don't do this kind of thing. But I'll actually look into that separately, and I'll get back to you guys this week on it.
Don't worry about it, man.
Well, no, actually now I'm sort of curious now. So, you know, we talked about how we have to calculate the ratios of debt and equity to get the total capitalization, right? So in this case, we find that debt as a percentage of the public market value is about 3.5%. Equity is about 96.5% almost percent. Again, our marginal tax rate selected arbitrarily straight lined out was 38%. And we blended in order to get sort of an average interest expense based on all the debt that's on the books of CBS. So risk-free rate. That's going to be the rate that's represented on money that you theoretically can't use. So in this case, we use Treasury bonds and Treasury bills. Arbitrarily selected 3.87%. I think a Treasury bill today is 4.5 or 5 or whatever, so we could easily use that. The unlevered beta is a measure of the sort of risk premium associated with the stock based on volatility. You know, so stocks that trade all over the place will have, you know, a risk premium or beta very high. You know, stocks that trade more consistently will have a relatively low risk premium. CBS is a major company, so their risk premium would be below 1. 1 would be the average risk, you know, amount of volatility. So the S&P 500 would have, like, you know, a beta of 1. You know, the average stock there. Okay, and you know, the risk-free rate, you know, subtracted off, you know, sort of the average market, you know, rate to get a risk premium. So that's how much additional risk you're taking to enter into this transaction. So again, weighted average cost of capital, we offered it out. It's going to take into account the elements that we listed in the slides. And again, the proportions of debt and equity, the specific cost of equity, cost of debt, and so we did all that to get our discount rate. Now, we just as easily could have said, which is probably what happened in practice, is that for this industry, you know, we use a discount rate of 12%, you know? You know, again, this is designed, you know, to work from sort of nothing. So our discount rate here, you know, we just listed, you know, again, just for the purposes of the organization, we just listed across all of our projected years. And we're going to use this to discount each one of those unlevered free cash flows.